welcome everybody, and thank you for attending our seminar this afternoon. Hopefully you'll have a bit of an idea of what's going on in the sort of international arena rather than just UK, which has obviously been affected by us leaving the EU. The front slide I think is really apt. The last 18 months have very much been a balancing act and hand-holding, so quite an apt slide there. So what are we going to do? We're going to cover goods first. We'll look at origin, importing goods from the EU and re-exporting them, the process at the border and what you should be aware of and why your agent asks you the questions they do. A bit on the Northern Ireland Protocol, which is obviously subject to change given what's going on with the government and changing it anyway. Evidence of export for VAT, which is an area that HMRC is now looking at in much more depth and how to avoid getting on the wrong end of it. The difference between postponed and deferred VAT, which I know a lot of people have struggled with. The import one-stop shop, which is the EU distance selling rules, which came in 1st of July last year. What we're seeing in terms of goods. And then we'll go on to services, any place of supply issues we found, the one-stop shop, which is different to the import one-stop shop, what's on the horizon, because there is quite a bit, and non-EU supplies. And I'll also touch on VAT refunds as well. So first of all, goods. Origin, we'll do some very basic stuff on origin, but origin underpins absolutely everything. So if your goods originate from a particular place and you do nothing to them, other than for EU, your goods will still originate from that place. So for example, if you import the goods from Japan and you do nothing to them and then you turn them around and re-export them, their origin is still Japan. And even if you buy them off a UK business and you then export them, you still need to know the origin of those goods. So it's really important that you know that. It determines the rate of duty in general terms, any preferences, which is where you will get a reduced or nil rate of duty, and any anti-dumping duties, which is the complete opposite of a preference, which is a super duty, primarily on goods that threaten now the UK market, but it was the EU market. You can change the origin of your goods by applying a significant process to it. And you have, when you do your classification, a chapter, a heading and a subheading. And if you change any of those, then you will have changed the origin, hopefully. So if you look at the simple example I've put in there, you've got cotton from India made into clothing from the UK. And that means that you come in, you have a bolt of material that comes in under one commodity code, and you have clothing that goes out under another. So that does change it. But you have to evidence it. So it's no good just saying, I know that that has come from such and such a place. HMRC and any customs authority will expect you to hold the evidence that you know where those goods have come from. So if you have a preference from an emerging nation or usually one of the Far East ones or African countries, you will need a certain type of preference certificate. If you're bringing goods in from the EU, you will need to have a supplier declaration as to the origin, although with the EU it is slightly different, and I'll come on to that in a second. But you absolutely have to be able to evidence that origin. So if you have a supplier who's refusing to give you an origin certificate, then it is going to cause you problems at the border. For the EU, you have 3 different types of supplier declaration. In fact, there are 2 different types of supplier ones and an importer knowledge. So your supplier declaration, you can have one for each individual consignment, and that's usually where you are importing different goods at, at different times. Or if you have the same goods coming in from the same supplier with the same origin, you can use a year's worth, if you like. So you have a multi-use one, and they have slightly different codings when they go into the declaration. The third one, and this is for EU goods only, is importer knowledge, and that relies on you as the importer knowing where those goods have come from, and you would be expected to keep evidence of that. So it's really important that you are aware of where the goods come from. Mixed goods, obviously we don't have in this it's a more complex world, we don't have single use goods or single origin goods. Quite often you have goods that come in and they're amalgamated into something else. And that can actually change the origin for good or for bad, depending on, where the goods are coming from. And there's a rule of thumb calculation that says that if 50% of the value of the finished goods are not originating in the territory, they will be classed as non-originating. And the 50% is usually based on the cost of the goods as a proportion of the ex works sales value. So you've got a bit of calculating to do. For some of the EU goods commodity codes, they will have specific calculations and it will depend on all sorts of different factors. But if you look at the rule of thumb one for most things, you won't go far wrong. So if you have something that is 50% or more non-originating, you will expect to have to pay duty wherever those goods are coming from or going to. So I've got a brief example here where you've got a computer cabinet made from steel produced in the UK, and steel has its own problems, even coming from the UK into the EU and vice versa, because of the protection of the steel industry in both parties. But this one has a heat-proof clear glass front, which is imported from the USA, and the cost of the steel is £1,200 and the cost of the glass front is £500. Ex-works price is £2,500. So there you have your 500 over 2,500, which gives you 20%. So obviously that doesn't taint the UK origin. So if the steel was imported from the EU, and the whole cabinet will be of non-originating materials, and duty would be due if it was re-exported to the EU, and that's a funny that we'll come on to in a minute. But by and large, if you change the nature of the goods, you will change the origin. And goods originate in a place if they are grown, produced, or manufactured in a place. And then if you change that by adding a process to them, then it changes the origin. So what happens if you import goods from the EU and then re-export them? So I said earlier that when you import goods from Japan, for example, they will still be Japanese origin when you export them. The exception here is the EU, because under a number of different statutes, they can lose their EU status the minute they leave the EU. And the UK-EU Trade Cooperation Agreement, or TCA as it's called, there is a preference that can be claimed if the goods originate from the EU and they're not subject to duty, but that's only on one leg, and that's usually when they're coming from the EU to the UK, or the UK goods, pure UK goods, going from the UK to the EU. So you can't claim the preference twice on both the legs. There are a number of solutions to this. They all need planning carefully and they all have costs associated with them. In the UK, the most effective solution in terms of theory is that you import under common transit, which is a specific scheme in the EU and transit countries, and the transit area is wider than the EU. You store them in a customs warehouse and then you re-export them under common transit. The effect of that is that they have never, in theory, come into the UK, and they effectively go EU to EU, and you don't have to worry about preferences and you don't have to worry about origin. So having said that that's the most common way of doing it, it's actually quite difficult to do, because you need to have people who are prepared to operate under the common transit system, and a lot of your shippers may not want to do that. You have to visit border force and inland border control facilities to have the transit discharged, and you have to be really careful when you're operating a customs warehouse. So the costs are actually quite high. However, if you look at renting warehouse in the EU, you're likely to have VAT registration requirements. You may not still be established, so you may still have customs issues. And the compliance costs from a VAT perspective are often quite high. Warehousing is also at a premium. We're finding here in the UK that warehousing is the exponential growth in commercial property at the moment due to Brexit and needing to store goods. You could just register for VAT in respect of acquisitions and utilise intra-community supply rules that we've known and loved for years. But again, you have to look at the VAT compliance costs, and you may have to register in several territories. You could establish an EU entity in the EU, but that usually requires staff and premises, and you may then have corporation tax issues. You may have social tax issues because you're employing staff. If you don't have any of those, you may be deemed to be non-established because you're not actually you've not got a footprint in the country other than perhaps a VAT registration. You can use the Northern Ireland Protocol. Now, this is something that does blow quite a few people's minds because the Northern Ireland Protocol in itself is quite tricky. But if you are caught by it, you can actually use it quite well in order to move goods around the EU because Northern Ireland has a dual status for goods. It is in the EU and it is in the UK. You have a special Northern Ireland VAT number and you can actually use that to move from supplier to customer without actually physically bringing the goods into the UK and use triangulation, which is what we always used to use pre-Brexit. You do have the downside that some member states aren't happy to accept an XI VAT number where the address is on mainland GB. But in theory, it works until, of course, the Northern Ireland Protocol rolls over. But at the moment, it still works. So what do we do at the border? You may find that your shipping or haulage agent or customs agent asks you a number of questions and you're really not sure why. The document that is generated for imports is a long document and there's a lot of fields, and it is, I'm going to hate to say it, get worse. There are a lot more fields under the new CDS system than there are under the old Chief system, which we're using at the moment. However, if you know what you're providing and why, it will make your life a lot easier. So you need the name and address of the exporter. That is the absolute bare minimum. And that is usually your supplier as a rule of thumb. If you can get it, their EORI number and their VAT number, but not necessary for the import document. If you're doing an export document, then it is necessary. So you need the name and address, VAT number and EORI of the importer if you're importing, and you need the delivery address if that is different to the importer address. And we have several clients who import and have deliveries to other addresses. The number and type of the package. Now, if your haulier is asking you constantly, what is the packaging? That's because there are very strict codes within the software that you have to use, and your package is usually the outer package. So if you have 20 boxes on a pallet, the package is actually the pallet, not the 20 boxes. So it's important that we, that your haulier or your person doing your declaration knows all of this information. An accurate description of the goods. Now that sounds like a stupid thing to have to say, but we're finding that most of the problems we're seeing at the border and also in post-clearance visits that HMRC are carrying out is that the description of the goods on the import or export document is not accurate enough to identify the goods. And this then causes problems. And we've had anything from kitchen cupboards to chair parts to whatever put on there, when in fact they are nothing of the sort. So you can imagine HMRC open a lorry or a van expecting to see kitchen cabinets and they see something completely different. They're going to not take it too lightly. The value of the goods. So just be aware that even if your goods are supplied free of charge, they can still have a value. And if they are described as samples, they can only be of nil value for customs purposes if they are in a form that's not available for resale or if they have been defaced. So you have to put in a value. So even if you have a supplier who gives you parts free of charge, you have to look at the value of those goods normally and add those to the declaration. Delivery terms can affect what the calculation of the goods price is when it comes to the software. It's a bit of a dark arts thing, and some of them will take off particular transport values and some of them will add them on. But your delivery terms govern what HMRC expects to see on the declaration. You then need the net weight, which is the weight of the goods without the final packaging. So in the example I used, it would be the weight of goods without the pallet. They may be in boxes, so you may have boxes within boxes. It's anything without the final pallet. And the gross weight, which is the weight of the goods plus the pallet or packaging. What it isn't is a container weight. So if you have pallets in a container, it is still the pallets that are the ones that we're after. Whether the goods are hazardous and the UN hazard code. Now, if you have hazardous goods, you will have a multimodal goods form, which specifies the UN hazard code and how much of each of the product there is and what the problems are with it. So they might be alcohol based, in which case they have a vaporization hazard, and that makes them flammable. They may be, if we go out on a limb, radioactive. They may be anything in between. So if you have your multimodal goods form, it's a good idea to provide that as well, because then your agent can compare the number that are on the form by the comparison to what are on the invoice to tie them up. If your goods need a license, you need to provide copies of those. So that's things like guns, any other form of weapon, controlled drugs, food substances, anything that might not be animal byproducts but might still be food related will need a license. And if it's food or food related, you have to pre-notify via something called IPAFs, which tells HMRC that the goods are coming into, and tells DEFRA as well that the goods are coming into the country. Now, at the moment, there are only certain foodstuffs that need to have the full vet checks at both sides of the border. By and large, those are meat products and also live animals. But most of them you will bring into the country without any need for a visit to a border control post to be signed off. That will change at some point in 2023, maybe even 2024. It was supposed to have changed by now, but it's gone into the too difficult pile. So if you've got foodstuffs, you will probably have a health certificate, you will probably have vets appointments lined up, or you may just have a different type of certificate if it's a low risk sort of food. You need to tell your agent whether you're using postponed VAT accounting. So we'll come on to what postponed VAT accounting is, but agents shouldn't or don't, as a rule, opt for that. There are a number of reasons, some of them cynical and some of them practical. Delivery costs if they're separately shown, because that can affect the value of the goods. And if you're using any special procedures, the agent absolutely needs to know. Otherwise, it's so difficult to unpick it after the event. So if goods are going into a customs warehouse or for processing relief or end use relief, which is mainly the ships and aircraft, or even temporary admissions if you're bringing things in for an exhibition or whatever. The license plate and nationality of the vehicle is an absolute must, and I get into so many arguments on the other side of the channel because they won't give us sometimes the license plate of the vehicle until they have an import declaration, and we can't do the import declaration until we have the license plate. So it's really important that the agent knows that, and it is a required field on the declaration for both import and export. And the registration number of any containers or trailers, particularly if they're containers coming across without a lorry, and any seal numbers on those containers so that they can be checked. The exit port from the EU, the entry port to GB or vice versa, that's really important. The approximate time of the crossing and how you will pay any duty if it's due. So if you're not paying VAT up front, then but you have to pay duty, you need a deferment account, or you need to use the flexible accounting system where you pay it directly to HMRC. And the contact details for the exporter and the importer in case there are any issues. If you can get a copy of the supplier's export declaration, that's great. There are certain countries that like you to tie the two up. If you ever look at the documentation, in the top right hand side is a barcode, and underneath is something called an MRN. It will start with the year, so this year it will be 22, then the country code, so IT for Italy, DE for Germany, PL for Poland, etc., and then a whole load of numbers and letters. In certain of the former Eastern Bloc countries, they like to check that those goods have been properly imported against an import declaration. So they will ask for proof that that MRN has effectively been discharged. So once you've got all of that information, it's entered into Chief or CDS from the 1st of October, and the import declaration can be submitted to HMRC. Along the way, there may be manual checks if things don't check out, if the weights look odd, or if there's a license and it's not been submitted, etc. And if there's no manual checks, then it will generate what's called an SAD, single administrative document. We call it a C88 here in the UK, and a pre-lodgement advice. Now, the important thing to note for both of these is that everything is well, most things are done predominantly via pre-lodgement. There are certain ports where it will go through the port system, but where it's pre-lodgement, it only means that a declaration has been lodged. It is not evidence that the goods have moved. And until that pre-lodgement is discharged, those goods are not evidenced as being moved. So particularly for the export documentation, which we will come on to later, although it's an indicator that you are exporting documents, you do need a lot more. What else do you need? Well, for exports from GB to EU, you need a security and safety declaration. It will be done by and large at the same time as your export declaration, looks very similar, has a different data set. Again, it's to make sure that the goods can continue on their journey safely. And if you don't do it on this leg from GB to EU, the goods can't cross. You don't need one for imports at the moment. That's another change that will come in 2023 or 2024. What you do need for both directions is a goods movement reference. That is linked to a new system called the goods vehicle movement system, and that operates on both sides of the channel. So what should happen is the goods are prepared, you generate your export or import declaration, or in fact, well, let's start again. The goods are prepared, the export declaration is generated, and it goes into the GVMS system. In the UK, you would get a GMR reference when you did that. In the EU, they get some other reference. And then that allows the importer to do their import declaration, because then they've got the transport details. If you don't do an import declaration, then you can't often get the right reference in order to move the goods. So if you're moving something from the UK, that's fine, but you have to get someone to do an import declaration in the EU and discharge the goods vehicle movement system to say the goods have arrived. When it comes back the other way, it's our GMR system, so that you would have your export declaration done from your supplier, you would do the import declaration, and then you would do your goods movement reference. If you don't have a goods movement reference, then in theory, you cannot board a ferry to bring the goods across. Now, we have seen goods come across without a GMR or an import declaration being done. They eventually do get caught out because HMRC track every single goods movement system, and they can select them for random checks. And if they open a lorry and it's got 4 consignments on it and only 3 have a GMR and a valid import declaration, the 4th one will be offloaded at the border control point. So just be aware that they can do that. So once you've got all of that, your goods can move and you can get them across the channel whichever way you want. If you're moving under common transit, you will need to call in an inland border facility to discharge it, unless you have authorised consignee or authorised consignor or statement. And if your goods are forced to unload, believe me, it is really, really difficult to talk sense, particularly in the UK ones, to the inland border facility. And the reason being is it's HMRC and Border Force combined. They appear to sit in desks next to each other and not talk to each other. So you have to talk to both sides. And it can take ages to unfree goods that have been offloaded. So Northern Ireland Protocol, most people avoid this like the plague because it is quite difficult. It was designed to avoid a border between Northern Ireland and the Republic of Ireland on the island of Ireland. I was fortunate to sit on an advisory committee for this, and it was quite an eye-opener about just what lengths they would go to on both sides of that border to make sure that there wasn't a hard border put in place, and that included destroying any infrastructure. So it's a very, very sensitive subject. Despite all the press sort of news about there being a border in the Irish Sea, there isn't. It is actually on arrival in Northern Ireland. You go to, again, inland border posts to discharge things. But it can have its uses when you are still dealing with the EU. But it's still not sorted. As you know, in the news, the UK has put through legislation to tweak it, and the EU is not very happy with it and says it's a breach of EU law. So we've got all of that going on. If I'm honest, if you look at Northern Ireland businesses, they're very happy with it because they get the best of both worlds. and they've actually thrived under it. The problem is the politicians more than anything else, and people moving goods from GB to Northern Ireland. So goods moving from GB to Northern Ireland are exports, but VAT is still chargeable. A very strange concept to get your head round. Part of that is because Northern Ireland is still part of the UK as a VAT territory, and part of that is because it flips from being output tax as we know and love it to being import VAT in Northern Ireland. So it's quite a different sort of concept. You do the export declaration through either your normal agent, they will be linked to the Trader Support Service or the CDS part of the Trader Support Service, or through the Trader Support Service itself. You can sign up to do it and file them. It's a limited data set. It's not the full data set that you would put into a normal export declaration, and that's because they want to keep the goods moving. But if you've got goods that are at risk of entering the EU, then you have to declare them and pay duty on them as appropriate. And the ones that are at risk are mainly where the GB tariff rate is less than the EU tariff rate. So it encourages smuggling by bringing them in from Great Britain rather than the EU. If I'm being honest, a lot of those goods in our GB tariff are at much better rates than the EU. So a lot of goods would be at risk. And to do that, you have to be registered as a trusted trader to be able to register them either at risk or not at risk. Goods transiting Northern Ireland to the Republic of Ireland are moved under onward supply relief. You don't have to apply for that, you just have to tell your agent that's what's happening. This is the old land bridge system where goods used to come into the EU, or they used to go from Great Britain via Northern Ireland into Ireland. To do that now, you'd have to use transit, and you would then also have to use onward supply relief. What that means is that there is no VAT for the GB to Northern Ireland route, and that VAT and duty is due in Ireland itself. So if you are the owner of the goods when they cross that border, wherever that may be, you may well have a VAT registration issue in Ireland. So just be aware of that. Northern Ireland to Great Britain, no declarations for any goods that have originated in Northern Ireland. So really easy to move. Goods coming into the EU destined for GB will be subject to duty and import VAT in the normal way, but in Northern Ireland. EU to Northern Ireland, they're treated as acquisitions in Northern Ireland if they remain there. And you can have a GB company operating under the Northern Ireland Protocol if it has goods delivered to a Northern Ireland address that it owns. You don't need an address in Northern Ireland to actually operate under the Northern Ireland Protocol, and all businesses VAT registered in Northern Ireland at Northern Ireland addresses automatically got their XI VAT numbers and EORI numbers. You need an XI VAT number, which looks suspiciously like your GB one, except that it doesn't have GB in the front, it has XI, but you do have to apply for it because it has to be recognised by the EU in the VIES system. If you don't do that, then you won't move your goods. Once you've got that XI number, you can utilise all the old EU rules for goods, including triangulations, and you can have your customer order the goods via your XI VAT number and have them shipped directly from, say, Germany to Spain or wherever. So quite useful. Northern Ireland to EU are dispatches, and again, you can still have a GB address. So the effect of that is that those empty boxes on the VAT return that you thought you'd never have to use again, you have to use them if you are operating via Northern Ireland. You still have EC sales lists and you still have interstats to do. So you're still caught for those goods movements under the EU rules. So evidence of export for VAT. This was always a happy hunting ground when I was a VAT officer back in the late 80s, early 90s. And that was because everything was either an import or an export, and it was easy to say, okay, here's your zero rated invoice, where is your evidence of export? When things became dispatches and acquisitions from the EU, the volume of exports and imports decreased, obviously, because we were treating them slightly differently, and the evidence that you needed was slightly different for both. If you don't have the right evidence of export, HMRC will assess you for 20% VAT on the basis that the goods have not actually left the UK, and it's then down to you to prove that they have gone. and then you can then readjust it on your next VAT return. In truth, this is really difficult to do. So HMRC has some really woolly guidance in Notice 703, and that tells you what evidence you need, but it doesn't actually give you much of a steer as to what evidence out of your own systems you need. So they will say you need a basket of evidence, but they may not tell you what's in there. So you've got official evidence, that's the SADs with their goods departure message, because as I said, the export document on its own as a pre-lodgement is not evidence of export. Or your commercial documents, so that's your bills of lading, your airway bills, CMR, which is for road transport, certificates of shipment showing how the goods have left, a seaway bill, international consignment notes, etc., proof of delivery, that sort of thing. Although HMRC are starting to say that proof of delivery is not commercial evidence. So even if you've got your Royal Mail proof of evidence, proof of delivery, or your DHL one, HMRC are starting to say that isn't sufficient. Although there is case law that suggests it is. But on top of that, so you've got an either or there, you need to have your supplementary evidence, delivery notes, correspondence, packing lists, customer orders, all of those sorts of bits of correspondence, and you need to keep them in a package ready to hand to be able to give to the VAT officer. They will only give you a certain number of weeks to do it. And going back after the event to get the commercial document out of your shipper is actually very, very difficult, particularly if you're talking 4 years behind, because of course HMRC can go back 4 years. So it's really important that your logistics teams know to give you in the accounts teams or the sales teams or whatever the right documents in order to be able to do the evidence of export. It's even more crucial if you do something on Ex Works, because if you ship on an Ex Works basis, your customer is responsible for all of this, and they may not give you the evidence of export. And the HMRC's advice on that is that you charge VAT and then credit it when they give you the right documents. And HMRC does actually say that copy documents are not sufficient. They have to be certified as a copy of the original. So, you know, if you're relying on somebody else's evidence of export, it puts you much more at risk, and you should be safeguarding the VAT. I have found from experience that charging UK VAT is actually quite a good way of getting your customer to provide you with the evidence of export. It does make them move a bit quicker because they don't want to have to go through getting a claim back. But Section 6, VAT Notice 703, details all of that. So whatever evidence you have, it has to contain all of the following information: the name of the supplier, the name of the consignor, where that's different. So if you're having goods moved to somebody else to be put into a shipment to go somewhere, then the consignor name will be different. The name of the customer, a description of the goods, and that has to be very accurate. It doesn't have to be on the declaration, although that would be preferable for other reasons, but it can be on the invoice, it can be on the delivery note, and there is very good case law behind that. An accurate value, and again, you may have reasons for not wanting to put a value on a customs declaration, but you do have to have the value somewhere else. And there was a case this year on this, and this was where things were being sent through the post. And through the post, you have a sticky label that you put on the front, and on the value part of it, they put a nominal value. But on the instructions to the Royal Mail, they actually put on the true value and evidenced it with an invoice. And HMRC said because the front of the package was inaccurate, then there wasn't enough evidence, and the courts overruled it. So as long as somewhere in that package you have got the accurate value and description, then that's fine. The export destination, which is fairly obvious, and this is the bit that catches people out time and time again: the mode of transport and route of the export movement. So if it's going out by lorry, we need to know which port it's gone out of. If it's going out by air, which airport, etc., etc. And that is not actually put into much of the commercial or official evidence. So you do have to have a sort of correspondence trail that shows where that's going. And if your delivery notes have the number of packages on that you can tie up to your DHL way bill or whatever, all the better. I spend an inordinate amount of time doing walkthrough documents for HMRC saying this ties up with this, this ties up with this, this ties up with this. And I did actually have to take them to task because we had waybills for one of the couriers, which quite clearly above the barcode said LHR to JER or somewhere like that. And they queried, they actually specifically said, your evidence of export does not contain the mode of transport and route. And I said, well, what does LHR mean to you? And JER, if you look them up, they are the international airport codes for London Heathrow and Jersey. And therefore, it's quite obvious they're going by air and that they're going from Heathrow to Jersey. And they had to concede that one, but they weren't prepared to originally. So those 7 bullet points are a legal requirement. And they have force of law. So without that information, you have no evidence of export. So just be aware, you could have an email from your client saying, yeah, I've got the goods, but that won't necessarily be enough. So postponed and deferred VAT, they're not the same. They are quite confusing, they're not the same. Postponed VAT is available to everyone who is VAT registered in the UK and importing goods. You do not have to apply for it. You don't have to ask HMRC anything. All you have to do is tell your agent you wish to use it. When you're using postponed VAT, the VAT's not paid at the point of import, so that speeds the goods going through the port, but you account for them on the VAT return as a reverse charge. So for everybody who was used to doing things from the EU before Brexit, it's very similar. You account for VAT in box 1, and then you account for VAT in box 4. And then your value of the goods goes in box 7. So very similar, you've got it in and out and a net value in box 7. So you don't have to pay any cash up front, you don't have to incur any charges on it, and it means that you don't directly pay it. The legal position is that you must account for postponed VAT on the VAT return covering the date of import. That's regardless of whether you get a postponed VAT statement from HMRC, and they are quite problematic, but that is the legal position. So what most people do is they look at the supplier invoice, they code it to postponed VAT in their accounting system. It will probably convert it if it's not in sterling using an online rate. It will times it by 20% in each of the boxes, and that's it done. When you get your postponed VAT statement, you will see that the values are slightly different, if indeed you can get back to the original invoice, and that's a different matter. And that will be because HMRC uses its own exchange rate, which is predetermined, and it will also add and deduct transport costs as part of the declaration, because it's all based on the declaration. So any differences you have, you just then adjust on your VAT return. Your postponed VAT accounting statements you sign up for. So if you haven't already done it, you need to do it. They weren't going to put the historic ones in there, but I believe they have now. So it used to only be 6 months worth. I think you can now go back and get the others. They've had problems. So you will find January, February and March 2021. We found duplications, we found omissions, and we found all sorts of issues with them. We then had another problem in April 2022, and I've still got clients who can't get their April 22 statement, even though they know they've imported. So notwithstanding getting that statement, you must put it on your VAT return at the date of import, and then you are covered. You should also then reconcile what you've put in your accounting system with what's produced by HMRC, and anything that doesn't tally should be queried with them, because agents are not above using somebody else's IORI number just to get things through quickly and not realizing the effect that it has on their postponed VAT statement. The same applies to your C79. If you haven't opted for postponed VAT and you're still paying VAT up front, you get the green certificate, which if you scan it is virtually impossible to read. But you should be reconciling your C79 certificates to make sure that there isn't anything spurious on there. We have asked HMRC to increase the data set, particularly on the postponed VAT statements, because if you're trying to get back to an invoice, it is virtually impossible to do from the VAT that's on there, unless you have the import documents or you have subscribed to the management's support service, MSS feed, which you can pay HMRC to do. It's about £250 a year, and that shows you virtually in real time what's going through under your EORI number. It will do it on a line-by-line basis, so you will have one entry, but every line that goes on that import document will be separated out completely. So you may find that one entry has 2, 5, 10, whatever lines on it. So it makes it quite a big spreadsheet, but it comes out as a CSV, and it means that you can then sort and filter it, which you can't do with the postponed VAT statement. Okay, there's the link there, and you will get a copy of the slides if you haven't already done it. The Start Now option is towards the foot of the page. You go through, you answer all the questions. You have to sign in via a government gateway account. Please use the one that you use to apply for your EORI number. If you've only got the one, that's fine, but I did find clients who had used very different government gateway accounts, one of which was their business rates one, which we'd never have guessed in a million years. But that's, you know, if they had to apply for the EORI number, you need to use that government gateway. You go through all the questions. They will give you a couple of emails potentially. One will say you've already signed up to this service. Ignore that. Don't know why they send that one. The other one will say you have now signed up for the service. Once you get that one, you go back through that link, you put your government gateway details back in, and hey presto, they turn up, and you will see your statements there in theory. You will normally see them in the account towards the 8th of the month. So the June ones should be in the next few days, as long as HMRC hasn't got any problems. But if you don't find it there, don't be surprised. Just keep checking back in, because it was as late as the end of May for the April ones. So just be careful. So deferred VAT is something completely different. VAT still isn't paid at the point of import, but is deferred to a credit account with HMRC. Now, you may have your own deferment account. You would know because you have something called a DAN number, and you may have a guarantee behind it, which you probably want to look at because you don't have to have one now. And then when it gets to the end of the month, every import that's gone through under that deferment account number, DAN number, is then produced on a statement, and they collect the whole of the VAT and duty in that month via a direct debit in the middle of the next month. So you effectively get about 6 weeks credit. You have to apply for a deferment account, so you definitely know if you've got one, and you need a UK bank account to pay the direct debit from. You may need a guarantee if you're not in the UK, or if the assets on the business balance sheet are not sufficient for the amount to be covered. Now, the assets that they take into account are all your tangible assets, and the one that they don't allow is goodwill. So if you've got a big goodwill figure on your balance sheet and small other assets, then you won't get a very high waiver, and you will need a guarantee. You can have a hybrid. They will use a waiver up to a certain amount and then ask you for a guarantee for the rest. And if you already have a guarantee, I would suggest you look at it, because you may not need it, and it's a cost that you don't need to incur. So once the month has passed, you will receive a deferment statement showing everything allocated to the account, and that is VAT and duty. It is not the document that you can use to claim your import VAT. You should reconcile it with your knowledge of what's come into the UK, and also to your C79, because that's what you will receive showing the import VAT paid. And that C79 is the document that you need to claim the VAT back. If you have entries on there that you don't recognise or are not sure about, you should query them, because they may not be yours and you can't claim back the VAT if they're not yours. And it's a reconciliation that you should do. Again, getting back to the invoice is difficult because it's got a limited data set. You may find that your agents will say, well, you haven't got a deferment account, so we'll put it to ours. And they all have VAT and duty deferment accounts. It clears the goods more quickly, and it does, because HMRC knows they're going to get the money back at some point. They will charge you up front still, and then they will use the 6 weeks credit, and they will also, or may also, charge you for the use of it. And I've seen between 3 and 12% of the amounts deferred. So if they've deferred your VAT, that can mount up to quite a bit when you don't necessarily need to use it. And I always say to clients, you don't need a duty deferment account if you're not going to have any duty, because you should be using postponed VAT accounting, because that's much quicker and has no cash flow for you. Even if duty is due, you can use the flexible accounting system. It does slow through the clearance of the goods because you have to pay the duty up front, and your agent has to notify HMRC that the payment has been made, and then there's all sorts of things that go behind the scenes. But it is there, and I think most agents have it. They have to be approved for it. You will get an accounting reference and you just make the payment electronically. I have a couple of clients that do that quite successfully. That will be replaced by something called the cash purse or cash account in CDS, and you can actually physically put an amount in there for your agent to draw down against when the goods come in. But that will be from the 1st of October, and your agent has to be authorised by you to do it. Import One-Stop Shop, or IOS. Much discussion over this. The EU think this has gone really well, and it has to some extent, apart from the thriving black market on IOS VAT registration numbers, and apart from the fact that the amount that you can import under IOS is actually quite small. And the reason why it's small is because it's tagged to the customs rules and not the VAT rules. And so there's a lot of work afoot to try and get that raised. But it's there for distant sales of goods imported into the EU and sold to consumers, where the importer or the supplier is responsible for all of the documentation, etc. You register for IOS in a member state of choice. And at the moment, even if you are operating under IOS in Northern Ireland, you can't yet register for IOS for HMRC. You can for the OSS, but you can't for the IOS. You account for VAT on all the sales under €150 or £135, and that's the total consignment amount. So if your goods in the package go over that £135, then you can't use it. And you only have one return and one payment to one tax authority, so quite easy. If you're selling via an online marketplace like Amazon, eBay, Etsy, etc., by and large, the online marketplace is responsible for the VAT and they will sort it for you. You can't backdate the registration. You can get round it by passing the responsibility for customs duty and VAT, etc., to the customer, but you should state this in your literature and on your website, because it doesn't do much for your customer relationship if the customer thinks they've already paid all of this and then they get charged it again. The UK does have similar rules for online marketplaces for goods coming into the UK, but not an IOS registration system. So everybody has to register who imports into the UK. So what are we seeing? Bizarrely, last year, a lot of goods came across with no declarations being done. And we're finding this more and more frequently now. It's usually highlighted by a post-clearance customs visit or investigation, so it does cause problems. Potential loss of the revenue to the UK Treasury if duty was due for whatever reason, because it won't have been declared. And also, if you haven't accounted for the actual import under postponed VAT accounting, then you will be assessed for the VAT. You can't retrospectively use it. We've had issues with GMRs being invalid, and that was at Calais in particular. There was some quirk in the system that meant that the barcode was scanned and the GMR came up as invalid. Caused a bit of a flap at the time, seems to have settled down again, but these things happen. After 2 or 3 attempts, it would go through. So who knows what was happening there. GMRs not applied for on part loads, leading to part of the load being offloaded. We've definitely seen that on a few occasions. No documentation supplied by the agents to evidence export or to help reconcile postponed VAT accounting statements or C79s. A lot of agents will not provide that information to you as a matter of course. You need a process to ask for it. Delays due to pre-notification for IPAFs. If you haven't done it, it's not easy to do on the hoof. Incorrect details on invoices and package listings. So we've had incorrect commodity codes, we've had incorrect weights, we've had net weights that are more than the gross weights, we've had weights that look total, sort of you say, are you sure that one pallet weighs half a ton? And they come back and say, actually, no, it's 6 pallets. That makes a bit of difference, obviously. So, you're picking up all sorts of errors that way. Where goods come in through the ports, they will come through the port system, and it's called temporary storage. And this is for the roll-on, roll-off ferries. If it's deep sea, it's something else, but they're usually where they're containerized and not accompanied. And you have to claim something called a unique consignment number, and that goes through the port system. So when it gets loaded on the ship, it's allocated this UCN. And you may have a split UCN if it's a number of consignments in the same container or on the same shipment. When it arrives at the port, that UCN is entered into the port system, and until that is claimed by the person making the declaration, you can't collect the goods. So that causes a few issues. VAT on imports into the EU starting to be levied and collected, and duty as well. Shipments returned or destroyed due to incorrect paperwork. That was particularly on exporting from the UK to the EU. And just to be aware that if you haven't got the right paperwork, the rules actually state that either the customs authority in the recipient country destroys it, or they send it back for HMRC to destroy it. So you don't really get too many bites at the cherry if it's wrong. Agents charging for use of deferment account when it's not required. GMRs not applied for in respect to return journeys. So just be aware that if you go across in your own van, you take goods, you come back with an empty van, still needs a GMR. So just be aware of that. And repairs being subject to VAT and duty. So under the TCA, there is a provision there that says repairs shouldn't be subject to VAT and duty by either party. In reality, the only way to do that is to have processing relief, which has always been there. So you have to apply for that. So services were on the face of it, the easier end of Brexit, because we didn't actually, on the face of it, change a lot. So the place of supply of most business-to-business services remains where the recipient belongs. So, all the things we've known and loved. You don't have to put their VAT number on the invoice anymore like you used to, but it doesn't harm to put it on there. You do still have to put a narrative on there to say why you're not charging VAT, and reverse charge is sufficient. You can say reverse charge under Article 44 of the EU directive if you want to, or you can say reverse charge under the UK provisions. It really doesn't matter, but reverse charge is the bare minimum. The basic supply for B2C, business to consumer, remains where the supplier belongs for some services, but not for others. So where it's intangible, about things like IP, supplies of staff, financial services, various electronically supplied services, advertising, consultancy, online training, that sort of thing. The place of supply has changed to where the recipient belongs, and that is for outside of the UK. Now in the EU, it's quite often not taxed there because the EU rules are slightly different. But you have to be aware that for some services, even where they're supplied B2B, you have use and enjoyment rules, and I will touch on those in a minute. And there are also domestic reverse charges that may override the original place of supply rules. So if you take the example of construction work on a UK property is usually subject to UK VAT, and you would expect an overseas construction company to have to register in the UK. However, deep in the sort of UK legislation is a piece of law that says if the overseas supplier is not established in the UK and the recipient is established in the UK, then a reverse charge applies. And that then means that the overseas supplier doesn't register for VAT. The interaction between that and our own reverse charge for construction is interesting and overly complicated, so we won't touch on that. But by and large, that's what it says. And it's always been there, and it came about a few years ago in a tribunal case called Muster Inns, where they had a Guernsey construction company who were refurbishing Muster Inns pubs. And the Guernsey company registered for VAT, charged VAT, and Muster Inns claimed it back, so no problem there, except that the Guernsey company went into administration and didn't pay HMRC the VAT. So when HMRC came to look at it, they invoked this piece of legislation and said it's a reverse charge. So you weren't entitled to claim back the input tax, and muster inns had to repay all of the VAT. So it was a big VAT bill for them. And when that case came out, I know a lot, including me, of advisors who were like, wow, where did that come from? And it is there, and it applies to an awful lot of things, including the exceptions to the normal rules of place of supply of services. So things like the provision of physical educational events or exhibitions or things like that can be overridden by domestic reverse charge. And a lot of EU countries apply this, and they're starting to apply it much more because of the number of UK businesses that are having to register. So use and enjoyment. What is use and enjoyment? It is an anti-fraud mechanism, which is similar, which is another mechanism like the reverse charge, really, to try and cut down on fraud. So if you have a particular service in a category that's invoiced outside the territory but used and enjoyed in the territory, you can get the place of supply reverting to the territory where it's used and enjoyed. So an example of that is you may have a UK company that invoices a US company for, say, electronically supplied services. So normally the place of supply would be where the recipient belongs, and that would be the States. However, if that service is used and enjoyed in the UK or in France or somewhere like that where they have similar rules, then you have VAT in the UK or France because of where they are used and enjoyed. So you get a VAT charge. And if it's not the UK, you may have to register elsewhere. The flip side of that is if you have a UK company that you're invoicing, but the use and enjoyment of those services is in the States, then you don't have to charge the UK company the VAT. So it works both ways. They are different categories in different member states. So the most recent one I came across was advertising in Finland. So the Finnish supplier for the advertising services had charged Finnish VAT. The client rightly checked it. Finland has use and enjoyment on advertising, and if the only place those adverts were going to be seen was Finland, use and enjoyment is in Finland, so Finnish VAT applies. In this particular case, well, normally you would claim it back via a special claim scheme, but if you are in certain sectors that are exempt from VAT in the UK, they are probably also exempt in other member states. And if you are exempt in that member state, you can't claim the VAT back. So you end up with a VAT charge, albeit a Finnish one. So it is really complicated and you have to look through it. It can apply to business and or business to consumer transactions. So don't just assume because you're supplying a business, it won't apply. The UK ones are broadcasting services, both B2B and B2C. Telecoms and electronically supplied services, B2B only. Repair work done under an insurance claim is B2B only. Letting of goods, including means of transport, B2B and B2C. So if you are letting goods that are used and enjoyed in the UK, but the place of supply would normally be outside the UK, then you may well have a problem with use and enjoyment and have to charge UK VAT. The one-stop shop is another simplification, and I use the term lightly. For those of you that were used to the MOS services, you'll be quite used to this concept. It's very similar, but it's an expanded group of things that are caught. So you have two. You have the union and the non-union OS. So the union OS is for EU businesses that make cross-border supplies of goods and services to consumers. So that most EU businesses have a seat in the EU and will use that scheme. It can be used by GB businesses who make supplies of goods to consumers from stock located in the EU. So if you've got stock warehoused in the EU, including Northern Ireland, you can actually use the union scheme, which is obviously easier to use than the IOS. If you have, if you're under the Northern Ireland Protocol, you can register for the union OS via HMRC, so you can still use the same portal as we always used to use, and it records all the movements of goods, but not services. Online marketplaces can report via the OS for suppliers located outside the UK and the EU where the goods are in Northern Ireland at the time of sale. So that's the online marketplace rules. And if you have a nil return, you still have to submit it. And once you've had 8 nil returns, the OS registration will be cancelled. So, be careful. You have to register by the 10th day of the month after the first supply. So if you did a supply on the 1st of July, you'd have to register by the 10th of July, and then your registration takes effect from the first day of the calendar quarter after the application to register. So it will take place from the 1st of July in this case. Returns are quarterly, which is good news because they used to be quarterly for services and monthly for goods. They are quarterly for both, and they are the calendar quarters, so they're easy to recognise. And the other good news is you now have longer to pay and file them. You have until the last day of the month following the end of the quarter, whereas before you had to get them in by the 16th or the 21st. If you are within the EU rules, so if you're moving goods to Northern Ireland, you are able to use this. You have a pan-EU threshold of €10,000, and under which you don't have to use the OS, etc. If you're not under the Northern Ireland Protocol, you can use the IOS, or you get the customer to account for it, but you can't use the union scheme. And if you're an EU business registered for OS, you will have the same VAT number as your normal VAT number. If you're not established, but you're eligible, i.e. you have stock in the EU or you're operating for Northern Ireland, you will register first and then you will get your EU OS number. And you won't have to account for other supplies necessarily under the original registration. So the non-union scheme is for services to consumers supplied by non-EU businesses. NI businesses supplying services have to register for the non-union OS scheme. They might be registered for the OS scheme for their goods, but they can't register for the union OS scheme for their services. Again, you register in a member state of choice, whereas with the OS scheme, you have to register in the country where you're registered. And UK businesses have to have an EU tax representative to do it. And you do for IOS as well. And that is because when the TCA was negotiated, the level of information exchange was not as high as when we were in the EU. So we are lumped in with every other country that doesn't have high data exchange. It's been negotiated and it will change. It's a quarterly return again, and you've got the same payment facilities and timeframes as the Union OS. You will have a special VAT number starting with EU and 9 characters. You need to know the VAT rates and invoicing requirements for all the member states. And you can opt out of the OS, but you would need to register in every single member state where you have customers. So you're increasing your compliance. So the services that are covered, and you will note this says not an exhaustive list. This is straight from the EU legislation. It's actually designed for any services to consumers, although the EU haven't actually taken that up yet. You have telecoms, broadcasting, electronically supplied services, the old MOS services. You have admissions to events, cultural, scientific, sporting, artistic, educational, entertainment or similar, such as fairs and exhibitions, where it's consumers or non-registered businesses. Accommodation services carried out by non-established persons. So if you're renting out hotels and things, but you're not established there. Transport, valuation and work done on movable property. Ancillary transport services, that's loading, unloading and handling. Land-related services, so if you're doing some conveyancing for someone. Hires of means of transport, so that's your cars, whatever else you might be hiring, boats. And restaurant and catering services where the consumption is on ships, planes and trains. So quite niche, that one. But in theory, it should cover anything to a consumer. What's on the horizon? The concept of a single registration in the EU should be in the next 2 years. Problem being that trying to get them to agree to who would hold the registration is difficult between 27 member states. Compulsory use of the IOS, that's the one that should worry people the most, because if it's compulsory, you won't have the option of getting your customer to pay the VAT, and you won't have you know, any option for registration elsewhere. An increase in the IOS threshold to reflect the fact that the goods are more valuable. The issue there is that the customs values are different to the VAT ones, and they have slightly different sort of rules, so they're trying to thrash that out. For online platforms, the operator will need to collect and verify information on their users, including the seller's business nature. That will be from the 1st of January 2023, and the UK has subscribed to this. So you report via one member state, and it applies to operators inside and outside the EU, and your first declaration is to be filed before the 31st of December 2024. That will then be extended to reporting requirements for e-money and cryptocurrencies, and that includes who the clients are and who hold the money, so that the tax, the personal tax, can be addressed and the corporate tax can be addressed. A minimum corporation tax rate of 15%, which will cause Ireland problems because theirs is about 12%. It won't affect the UK. We're above 15% anyway, and I don't think we've signed up to this particular part of it. Work on VAT in the digital age and the gig economy, how you tax transactions that can't easily be seen. The consultation on that has now finished. The report's due out in the autumn, and I think we'll start to see more compulsory registrations in the EU and probably the UK. Consultations in both the UK and EU on the treatment of financial services, and the indicators are that they're looking at an option to tax or possibly mandatory taxation, so they're no longer exempt. A big increase in environmental taxes like plastic taxes. We've got one in the UK now, and that affects an awful lot of people. Increase on health taxes such as sugar levies and, you know, sort of fat levies and things like that. Digital services taxes on the increase, and also the trade wars that go with it. So the UK has a digital services tax. It's a form of corporation tax. It is levied on the big US players mainly, and the USA is not very happy with it, and they're threatening to put super duties on goods and services coming in from the UK. So it can spark a trade war. A review of aviation taxes, how effective are they? How does that fit with the green agenda? So we'll start to see movement on that. A review of the tour operators margin scheme in the EU. The UK has retained it simply because it ran out of time to be able to remove it from the statute book. So we may find it disappears in the UK. More flexibility for member states to have multiple reduced rates. We're starting to see that come through now. So Ireland, for instance, has just reduced rated its e-books in line with its printed books. We did it back on May 2020, because at that point the EU had already said that it would do a concession for e-books. But we couldn't do our women's sanitary products until we left the EU because the reduced rates hadn't, legislation hadn't come in. The flip side of that is that everything will be reported via the OS where it's business to consumer. So you've got more OS reporting requirements. Taxation at the point of consumption or destination in the EU by 2025. Last I heard on that, that is optimistic. Concept of certifiable taxable person, that's not people like me that are totally mad about VAT, although probably I should be certified. It is somebody who is a trusted trader, effectively. And that is causing problems in certain member states. So that's what's holding up 2025. And actually the EU Council has, no, the EU Parliament has said to the EU Council, you need to look at this carefully because it doesn't make sense. Non-EU trade, this comes up quite a bit because we focus very much on EU trade. They are our neighbours and we've done a lot of trade with them. But there are implications for people trading overseas in other countries, and they are quite swinging. So the biggest one is the US. So the US, as you probably are aware, is a sort of loose affiliation of the 51 or 52 states, and each state has its own taxing legislation. There is no overarching federal sales tax, but there is individual state sales tax. So whilst we have VAT, and that is a federal tax, we don't tend to have an Oxfordshire tax or a London tax or whatever. We tend to just have the federal one. What happened was that Wayfair, who you see advertised on the telly here, you can buy rugs and all sorts from them, were selling to customers in South Dakota. And South Dakota said, we want sales tax from you. And Wayfair said, well, we don't have a nexus in South Dakota. We don't have any premises. We don't have any staff there. All we do is sell to customers there. And the South Dakota courts and then the Supreme Court said, actually, you do have a nexus because you have customers there and you are selling remotely. And so what has happened is the Wayfair principles have extended across most of the US states. I think there's only 3 that don't have it. And it means that it's also been extended to services, and it's also been extended to people who aren't even in the US. So somebody selling certain things from the UK to the US could be caught by sales tax. The important thing to realize about US sales tax is if you're selling business to business, unless you are selling to a wholesale business, that business is considered to be a consumer and sales tax applies. If you're selling to a wholesaler, you have to get an exemption certificate. So what's covered by the sales tax? Well, by and large, goods, and each state has its own range of goods. It also has they also have sales tax holidays. So for instance, when the schools are about to go back after their summer break, you will find that there is a sales tax holiday for school uniform. So, you know, you have to be on your toes with that one. It can also apply to services. So we're starting to see consultancy court, we're starting to see electronic downloaded services court, and other such intangibles. And it is, you know, you have thresholds that are sometimes $100,000 or 100 or 200 transactions. So if your turnover is under $100,000, but you have lots of small transactions, you may well find that you have to register for US sales tax. If you're selling via an online marketplace, a lot of the states have very similar online marketplace rules. So by and large, your online marketplace will take care of the US sales tax. On top of that, you have use tax. And use tax is usually even more granular, down to almost like zip or postcode level. And you will find that people are asked to withhold the use tax from anything they pay to you. So if you sell to someone in the States and it's short of money, it may be because they've withheld some use tax. So you just have to be aware. Exports in the UK are 0 rated. If they are removed within 3 months of the date of supply and you've got your evidence of exports, but the subsequent import into the other country may be liable to VAT and GST or other consumption taxes if you are the person importing them. So just be aware that if you're moving your own goods for whatever reason, you may well end up having to register and pay GST, and particularly where you're delivering on delivered duty paid terms. If you're supplying goods and services to customers, you will almost certainly need a VAT or GST registration, not customers, consumers. So we always say, and I know a lot of people would cynically say, yes, you would say that, but do seek advice before undertaking or agreeing to a transaction, because if you get your contract terms wrong, you can then end up with taxes being deducted that you're not expecting. So overseas, it's not quite as simple. We do have to look at what happens on the other side of things, particularly with services. So if you look at Australia, for instance, even if you are supplying services to an Australian business, there is a reverse charge, but it's not mandatory, and the business has to agree to use the reverse charge. If there is any form of nexus to Australia, so use and enjoyment, that sort of thing, then you may find you've got a registration requirement anyway, and you can have a hybrid one where some of your services are reverse charged and some of them are not. And you can actually, from memory, register if all your services are reverse charged, but you've got GST incurred in Australia. So it's really difficult minefield to navigate. I haven't done some slides on it because I have covered it in the past, but if you have incurred VAT elsewhere in the world, there are very few countries outside the EU that will refund you that VAT. Within the EU, you have to look at the different rules for the different countries, which is no different to when we used to do the 8th directive refunds. The main difference is that it's all paper based. You need to have the original invoices sent. You need to have a certificate of status, which is taking 15 working days. And you have to send something alternative in the meantime. And for 2021, the deadline was last Thursday. So I think other than the Netherlands, I don't think you've got much chance of doing one. And Belgium's the other one which has a different deadline. If you have an overseas company that is incurring VAT in the UK, the year goes from the 1st of July to the 30th of June each year, so just finished for 2021-22, and it has to be in by the 31st of December 2022. The other country in the EU that has that deadline is Cyprus. So Cyprus is slightly different as well. Again, in the UK, very paper-based. They did trial a spreadsheet-based one, but it didn't go too well, and they have to go back to square one with it. So at the moment, even though we have been using a portal for the EU things for 11 or 12 years, HMRC can't seem to adapt it to use it for the 13th directive. So it is causing all sorts of problems. There are also certain categories in certain countries where it's not even worth making a claim. Ireland and France are the two that I can think of on the top of my head, because most of your costs will be accommodation and food, and both of those countries don't allow businesses to claim that on those. The exception in Ireland is if you go to a recognised conference, then you can get your hotel accommodation and some of the food back. So a lot of countries don't allow transport, a lot of countries don't allow fuel, so it narrows what you can claim. So my last few slides are, well, my last two, because the last one has got my contact details on it, are 10 top tips for importing and exporting your goods and the other one is getting your services right. So give clear instructions to your agents. Why is that important? Agents, by and large, are not jointly and severally liable for any VAT and duty due by their clients. However, if you have given clear instruction to an agent and they have ignored it, then they are liable for any mistakes. So that's why it's always important to make sure your agent is properly instructed. Regularly review your goods to check that the classification is still correct. Now, if you haven't done that post-Brexit, you may find that you are categorising your goods in the wrong place, or at the wrong rate of duty, or both. The UK tariff is about 9,000 lines shorter, no, 6,000 lines shorter than the EU tariff. So a lot of the classification codes have gone. So it's important that you look at it. And also check that you are still using the right one for what those goods are. If your goods have changed over a period of time, you may not be using the right one. Allow at least 24 hours for your agent to be able to tie all the paperwork up. We can do it much quicker than that, but it makes life very difficult, and for all agents leads to more mistakes being made. So give your agent as much time as possible. If you are using IPAFs and you've got licensed goods and things like that, you will need 24 hours because you're having to rely on a separate system to churn out what you need to put on the import declaration. Make sure you have your proof of origin in your documents and any licenses, etc. Use postponed VAT accounting wherever possible because it will speed things up. Always request a copy of your import or export documents. I always maintain that you have paid for those documents by paying your agent, so always make sure you get them. Check whether VAT registration is required elsewhere before shipping. It makes life a whole lot easier, believe me. It may mean that you have to wait a while before you can ship, but it may mean that you haven't got any problem at all. A lot of them will reverse charge it business to business. Consider any special procedures to help with your cash flow or to erase duty. So processing, customs warehousing, free zones when they're up and running, all of those will help if you're not having to pay things up front. Treat each transaction as if HMRC will open an inquiry into it. Now that should go for VAT anyway, but we have thousands of transactions for VAT. But treat it as if HMRC will, because at some point they will open an inquiry. And if you can answer all their questions up front, it makes life so much easier and you've got everything there. And my final one is, if in doubt, shout. There are plenty of people out there now who are able to help. We have our own customs practice here, which is why I'm talking to you today. We do declarations as well, and we pride ourselves on trying to make sure that our clients have every single piece of documentation they need. But if you're in any doubt about how your transaction should be treated, reach out and speak to someone who's going to be in the know. So services, check the status and location of your customers. Really important because that can change the tax treatment. Check for any reverse charges that may apply. So you may not have to register, or you may have something else that you need to do. Check for use and enjoyment issues because you may have to register or charge VAT or whatever. Retain all your documentation to prove that you have considered the issues. Even then, even if you get it wrong, even if HMRC or another tax authority says you've got it wrong, at least you've got your thought processes down on paper. And it's very difficult for them to say that you've done it deliberately or carelessly if you've done that and if you've sought advice. Consider using the non-union OS for consumer services. It will make your life easier, believe me. You've only got one registration. Don't assume that UK or EU rules apply globally. To be fair, don't assume that even UK and EU rules apply in the UK and EU because sometimes they don't. And don't assume that sales taxes are only on goods because they're not. Keep up to date with your developments in specialist fields. So if you're in financial services or digital services, keep up to date with it. Check that you've got no withholding taxes hidden away there that the customer has to deduct. And again, if in doubt, shout. So that's all from me. My contact details are on the back of the slides. We have a team of 4 or 5 here that will help you out with any queries, and I hope you found it useful. So I will stop sharing my screen now.